When it comes to property investing or even buying your own home, it's important to understand that yes, we buy with emotions, but we also need to understand what the data actually looks like. Now, when I refer to data, there's a bunch of metrics you can use, but what I want to focus on in this video is suburbs to avoid because there is an oversupply. This is where it's a simple game of supply and demand. If demand is higher than supply, we get price appreciation. But we not only need to look at what's in the current market, we need to look at what's coming in the next couple of years and moving on. If you're interested, keep watching. Hi guys, my name is Ravi Sharma and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now in this video, I want to showcase some of the suburbs that you may not want to actually be buying a property in because of a supply issue. Now this is an oversupply, which is basically where there's too many properties and there's not enough buyers. Now before I do continue, it's these sort of concepts, these sort of conversations that I'm having in the Patreon community. Definitely go join if you are interested in learning about cryptocurrency, NFTs, and financial freedom through Australian property. It's a combination of these things that I believe in the next 12, 24, and 36 months is what's going to get you to fast track your financial freedom rather than just relying on one asset class and focusing on that. Now we jump into the article. Sydney's outer ring suburbs of Schofields and Rouse Hill are among the areas facing the highest risk of oversupply as thousands of new apartments are set to come online in the next 24 months. Research from RiskWise shows. A total of 3,397 new units in Schofields in Sydney's northwest are on track to be added into the local housing market in the next 2 years, which will be more than double the existing housing supply. In Rouse Hill, also in the northwest, there are 1,274 units in the pipeline, equal to 88.2% of the existing stock.
Holy crap.
Now you need to understand, right? When a developer comes in and they try and purchase an area to go and build apartments, they don't come in and say,
Oh, well, based on the supply and demand of this area, what we'll do is we'll build 3 levels first, and that's what the people need. And then we'll build another 3 after that, and then another 3 after that.
It doesn't work like that. What they do is they build the entire thing first, and then you have an oversupply, and then as demand comes in, which is, hoping demand comes in, they come in and then they start filling it out. The problem is that so many people I speak to see a fancy brochure, they see first home buyer incentives, they go out for an apartment like this thinking, well, they've got a new metro station there, they've got new apartments, they've got new housing's so expensive, what's the next best thing? Let's go and buy apartments. So that's the sort of mentality that people have going into this. Now I'm generalizing, but the fact is that just last week alone, I've had 3 emails talking about the exact same thing of what they want to do. I thought it's time to address it. You're here obviously trying to learn about how to grow your financial wealth, but also how do you maintain and keep that wealth, right? You don't want to be going in and falling in for the narrative that some sales agent sold you or a buyer's agent sold you or advisor sold you on the fact that they're getting commissions from the other end and they don't really care about what you do. Doran Peleg, Chief Executive of RiskWise Property Research, said the large unit supply coming at a time when demand for high-density housing was lower compared with detached homes could dampen capital growth and rental potential for these properties. This is 100% correct because just because most people in the area want to live in a detached house doesn't mean they automatically now want to live in the apartment because they can't afford the house. It doesn't work like that. There are different metrics, different demographics as to why people want to live in a specific type of property. If you really have a large family, you can't go into a 2-bedroom unit, right? You like the area and it would be fantastic if you could live there, but the truth is you can't afford it. So are you going to go option A, I just purchase a unit on level 34, or option B, I move out to another suburb, say 5, 10, 15 minutes away, and that's where I'm going to purchase my home. Because you know what, if I'm thinking about my family, my kids are going to grow up, they need a bedroom for themselves, I need a 4 to 5 bedroom home, that's my move. They're not going to suddenly go, I can't afford here, I'm going to go to the apartment.
Doesn't make sense.
Generally speaking, off-the-plan apartments tend to underperform the market, particularly in areas where housing supply is already high. In the outer suburbs, where there is a scope for further development and where houses are more affordable and sought after, the growth prospects for off-the-plan units are even lower. And again, time and time again, I live in Sydney, I've been born here, and I understand the market really, really well. Why I avoid buying here, because I understand the metrics, I understand how a rental works, and I also understand why there's such an oversupply of particular type of property. Now, when I get to detached homes, yes, the capital growth is there, but I've got no cash flow. So I need both when it comes to really scaling up my portfolio, but also living a life of balance. I don't want to have 85% of my income go towards holding these assets, because at the end of the day, it's taking money out of my pocket. pocket. What I want to do is increase how much income I make so that I can make better choices around where I scale and start diversifying into different asset classes. What we're talking about here is off the plan apartments. The easy narrative to sell is basically this, and I'll tell you right now. Hey, look at this fantastic up and coming growth area where you can get an apartment where it's a fraction of the price for the detached housing that you can buy here. Now, you may not be able to afford a $1.2 million home, but what's the next best thing? A brand new apartment only 2 minutes away from the local shopping center and the new metro station, as well as the train stations around in the area. Now, you can purchase this for about $600,000 for a one bedder, or you can purchase it for $900,000 for a two bedder. It's a fantastic deal. You know what? It gets even better. You get the incentives from the government, but not only that, it's brand new. So you'll save tax as a depreciation as well later when you turn it into an investment. It's a really good area, it's growth area, and the rental potential is awesome because, hey, we said so. And not only that, you only have to put 5% deposit down today, and then in 3 years' time you can settle and you'll have so much capital growth.
Wow.
In Melbourne, Box Hill is posed to see 1,833 new units added to the market in the next 24 months, which is equal to 25.5% of the existing house supply. Footscray and South Melbourne are also set to receive large numbers of new units in the next 2 years, with 1,531 and 1,056 new stocks set to be completed respectively. Suburbs at risk of the oversupply. So this is the suburbs that I really would not be buying, especially if I'm buying an apartment. Housing is different. We're looking at just apartments here. So number one is Schofields with 115.7% of existing stock yet to come into the market. We've then got Box Hill in Victoria, Subiaco in Western Australia, Gosford in New South Wales, Footscray in Victoria, Perth in Western Australia, Rouse Hill in New South Wales, Broad Beach in Queensland, South Melbourne, Victoria, and Adelaide, South Australia. Now, with a lot of these areas that you're seeing on the table, it's a fairly easy sell. If you think about it, I can say, well, it's a brand new apartment near the beach. Why wouldn't you want to live here? And that's the emotions, that's the narrative that gets played. It's classic sales, right? But what we want to focus on is, why are we buying this property? Like, if it is truly an investment, am I basing this on numbers or am I basing it on emotions? Guys, take this for what you want, right? If you've already purchased here, like, good luck to you. And I think the bigger question to ask if you've already gone and purchased here is, why did you purchase? Because you don't want to repeat the same process. You don't want to repeat the same mistakes and just be sold on the idea that someone sold you an emotive story, a narrative to go, that makes sense to me, right? It needs to come down to how we can build the emotions with the data. In this case, narrative works, but when we go and overlook that with the data itself, which most people aren't doing, this is where you start seeing the mistakes. Now, on an average sort of apartment in Schofields, if it's costing you about 600K, I can tell you now, your max capital growth you're probably going to get is like 2 to 5%, and that's if you're lucky. Because the truth is, new apartments are going to start going up. Now, unless the demand starts rushing through to Schofields, now I know what's happening there, you're not going to get a huge amount of demand go through into that area. So what's going to happen is you've got these apartments, now there's no one renting it. So what do you have to do as an investor? I need to drop my rents until I can get someone. So now your rental appraisal is a lot lower than what you expected. Your cash flow is really poor. Your capital growth doesn't exist. And you know what's worse? Is that only in 6 months' time or in the next 12 months' time, there's new apartments across the road coming in, which means people like new. So why would they move to your apartment when they can pay an extra $10 to $15 and move to that apartment? This is where you're starting to see how people get stuck and they get sold on a dream that isn't really a dream when it comes to logistically buying your own investment property. Or if you're wanting to live here, then that's a different story. You can live there, enjoy it, that's awesome. You're buying with emotion. But too many people go in there thinking they're buying an investment property, but they're buying it with emotion. You're not gonna get it right. In Perth, the affluent suburb of Subiaco is at risk of apartment oversupply as 1,798 units are on track to come into the market. This is equivalent to 46.4% of the old stock in the suburb, whereas Perth CBD will get 1,276 boost to its unit supply when these properties are completed. Mr. Peleg said, with investors shifting to detached housing and family-suitable homes, the buyer pool for apartments was even shallower. If you want to sell your off the plan later on, it could be more difficult, he said. The second issue to consider is that there is uncertainty regarding international immigration, so we didn't know when the borders will reopen and how immigrants will come. Also, with flexible working arrangements becoming the norm, we don't know if and how people will come back to live in those units because people can spend the same amount if they move to Central Coast or to Brisbane. Now, an important point here is flexible working arrangements. We are realizing that we don't need to be close to a city to go and work there. We understand that now. Companies understand that, right? Where only 12, 24, 36 months ago, you would go and say to your boss,
oh, look, I'm thinking of working from home tomorrow. It's like, oh, yeah, okay, like you can. It's not ideal, but yeah, no, total, like
flexible working conditions, work-life balance, guys. But the truth is now, you're probably more likely to do it because companies understand it can happen and it works. So am I saying that, hey, all apartments are really shit, don't buy them, they're a bad investment? No, I've actually got a video here that I'll link up, which, discusses the difference between homes and apartments. I've got apartments myself, in my portfolio, and they've done really, really well. Some have actually outperformed the houses that I've actually got, and this comes down to understanding what the demographic wants, what is the supply and demand, and understanding what's in the pipeline about to come. You need to also understand one big thing, and I described that in this video in detail, so definitely check it out, is that why is your property unique? If you can provide a point of difference in your apartment or in something that has a large amount of supply, if you provide uniqueness, then someone is willing to pay for it. That ultimately is the game here, is if you can understand those metrics, match it up with the emotion and the narrative, I think you're on a winner. If you're someone who just sits there and looks at data, you're gonna lose because there's lag data, you're not gonna get the real picture. If you just base decisions on emotions, you're gonna get wrecked because you're basing it on a narrative and a story. When the two match up, and that's basically what we do with clients, is that we need to match both up. We need to talk to agents, we need to talk to people who are buying there, then we also need to match that up with what we can see in terms of data available to us. I hope you guys have enjoyed this video and learned a few things around property investing. If you have, definitely go check out my playlist around property investing and housing market updates that I do every week, and I'll catch you guys in the next one. Thanks, guys.